These two numbers, $487,000 and $113,000, represent the same person, same monthly investment, same market, same fund, same strategy. The only difference, the only variable between these two outcomes is the age at which that person decided to begin. The gap between them is $374,000, and that money did not disappear into a bad investment or a market crash or a financial mistake. It disappeared into time, into years that compound interest never got to touch. If you are over 40 and you have not yet started building wealth, or if you have started but you know you are moving too slowly, that number is already accumulating against you right now, today. In this video, I am going to show you the real math behind that gap. Not motivation, not inspiration. Logic. The exact dollar figure that every additional year of waiting removes from your financial future permanently. The three invisible forces that are destroying your wealth while you are in the waiting phase. And the controversial truth about why the financial advice industry has a structural incentive to keep you confused and inactive. But I am also going to show you something that most versions of this conversation leave out entirely. Why the 40-year-old investor has three specific advantages that no 25-year-old on the planet can replicate. Stay with me until the final chapter, because that is where this entire conversation turns. Chapter 1. The number they never showed you. Here is the math that makes this real. A 25-year-old who invests $500 a month in a broad market index fund, historically averaging 10% annual returns across decades, will accumulate approximately $487,000 by the time they turn 65, 40 years of compounding. Not because they were exceptional investors, not because they timed the market or found the perfect stock, simply because they began. Now, that same person, same $500 a month, same fund, same historical 10% average return, but they wait until they are 35 to begin. $188,000. 10 years of delay removed $299,000 from that outcome, not from the account, from the future that the account was building. And here is where it stops being abstract and starts being personal. Start at 40, the same strategy, the same $500 a month, the same fund produces approximately $113,000 by age 65. I want you to hold that number for a moment before we move forward. $113,000 against $487,000 for an identical investment made in an identical market.
The only variable is the calendar. Now, most financial videos show you this chart and then immediately pivot to urgency. Start today. Time is running out. I am not going to do that, because urgency is not the problem. Most people in their 40s already feel the urgency. What most people do not yet understand is the precise mechanism by which waiting destroys wealth, and what that means for every month going forward. Let me show you that mechanism. Chapter 2. The Compounding Assassin. The most misunderstood concept in personal finance is not investing. It is time. Compound interest is not primarily about the money you put in. It is about the time you give that money to work on itself. In year 1, your $500 earns a return. In year 2, that return earns a return. By year 15, you are not just earning returns on your contributions, you are earning returns on returns that have themselves been compounding for over a decade. The money is no longer just working for you. The previous work is working for you. Think of it this way. Imagine two farmers. Farmer A plants his orchard in his 20s, methodically, patiently. By the time he reaches 40, he is not just harvesting from his trees, he is harvesting from trees that are themselves fully mature, operating at maximum capacity. Farmer B says he will plant when the time is right, when the soil conditions improve, when the market settles, when he has done more research and built a more comprehensive plan. By the time Farmer B begins, Farmer A has already eaten for 15 years. And here's the part that most people miss. Farmer B does not just lose 15 years of harvests. He loses the harvests from the harvests he would have had. the compounded productivity, the fruit of the fruit. That is what compound interest actually does, and that is why the cost of waiting is not linear. It is exponential. Every year of delay removes not just that year's contribution from your future, but that contribution's ability to compound for every subsequent year of your investing life. The math does not care about the reasons, it only tracks the years.
Chapter 3. What 1 year actually costs you. Most people think about financial delay in years. I will start next year. When this settles, I will get serious. After this debt is handled, then I will begin. But compound interest does not operate on years. It operates on months, on weeks. So let me make this granular, because the numbers at this level are the ones that actually change behavior. If you are 40 today and you begin investing $1,000 per month in a market-indexed fund at a 10% historical average annual return, you will reach approximately $1.18 million by age 65. Wait 1 year, start at 41. Same $1,000 a month, same fund, same return. $1.06 million. 1 year of waiting cost you $120,000. That is a college education. That is a down payment on a second property. That is a legacy asset for your children that will simply not exist, not because of a bad investment, not because of a market crash, but because of a calendar. And I want to be direct with you. I understand that for many people watching this, $1,000 a month is not the current reality. Perhaps the number is $300. Perhaps it is $500. The proportional math is identical regardless of the contribution amount. The point is not the size of the number. The point is that every month you remain in the planning phase, in the "I am going to start soon" phase, carries a precise and permanent cost that does not negotiate with your reasons. There are also 3 forces, beyond the missed compound returns, that are working against your wealth right now while you wait. Most financial content names 1 or 2. I want to name all 3, because together they are far more destructive than any of them are individually.
Chapter 4. The 3 Invisible Wealth Destroyers. The first is inflation. Every year that your capital sits without growing at a rate that exceeds inflation, you are losing purchasing power, quietly, automatically, without a single market event. Historically, inflation runs at approximately 3% annually. That means $100,000 sitting in a standard savings account today has the effective purchasing power of roughly $74,000 in 10 years. You did not make a bad investment, you did not lose money on paper. But real wealth, the kind measured in what your money can actually do, eroded every single day you waited. The second destroyer is opportunity cost, and this is the one that is most severely underestimated. We already established the gap in compound returns, but opportunity cost goes deeper than that. Every dollar not deployed in a growth vehicle is not simply failing to earn, it is also failing to provide the compounding base for every subsequent layer of growth. At the peak of a long-term investment cycle, the opportunity cost of early inaction does not merely match your actual investment returns. In many scenarios, it exceeds them. The money you did not put in at 35 is not just the $500 monthly contribution you would have made. It is everything that $500 would have become, compounded, layered, built upon for the following 30 years. The third destroyer is the one that most directly applies to professionals in their 40s. It is lifestyle creep. By the time most people reach this stage of their career, they are earning more than they ever have. Their income has grown meaningfully, their career has matured, and almost without noticing, so has their spending. Better housing, a better vehicle, private education for children, travel, the experiences that feel earned and in many cases are earned after 2 decades of building something professionally. I am not here to argue against any of that. You built those things. The logic question is simply this: what is the ultimate purpose of that earning, if not to eventually build something permanent that outlasts the earning itself?
Your income at 40 is your single most powerful wealth-building tool. The question is whether it is currently being deployed as a tool or being consumed as a lifestyle. 3 forces: inflation, opportunity cost, lifestyle creep. Not the challenges of people who are failing financially, the silent challenges of people who are doing reasonably well, and that is precisely why they are the most dangerous.
Chapter 5. The Controversial Truth.
Here is the take that I expect will generate some friction in the comments. I am placing it here deliberately because I think it is one of the most important things this channel can say. The financial services industry is structurally designed to benefit from your confusion and from your delay. I'm not saying every financial professional operates in bad faith. I am saying that a system built on management fees, on the narrative of complexity, on the idea that you require expert guidance before taking a single step, that system does not have a financial incentive to deliver the simplest, most validated truth in personal finance. Begin early. Invest consistently. Keep your costs low. Because if that were the primary message, if every platform led with that truth, the advisory model that charges percentage-based fees to manage what could be a low-cost index fund would collapse overnight. This is not a theory. It has been validated across multiple market cycles by independent researchers, by index fund data going back decades. A 40-year-old who begins today, contributing $500 a month to a low-cost, broadly diversified index fund, will, in the overwhelming majority of historical scenarios, significantly outperform a 45-year-old who spent 5 years assembling the perfect plan and then invested twice as much. Time beats strategy. Consistency beats timing. Starting beats planning to start. That last statement is not motivational language. It is a mathematical one. And it is the foundational logic of everything this channel produces.
Chapter 6. The Logic Reversal. Why 40 is Different. Now, the chapter I promised you at the beginning, the one where the logic turns. Because everything we have covered so far has been about what the math costs you. This chapter is about what you have, right now, at your current age, that no 25-year-old investor on the planet possesses. The first advantage is income. The average professional in their 40s earns meaningfully more than their 25-year-old counterpart, which means the compressed timeline you are working with can be partially offset by significantly higher contribution rates. A $500 a month investor at 25 has far fewer levers to pull. A professional at 40 often has the capacity, if they choose to redirect even a fraction of their current income, to contribute at 2, 3, or 4 times that starting rate.
I was reading through one of the largest investing communities this week, a thread that crossed 1,600 upvotes, over 1,000 comments, from people who had crossed the $1 million mark around the age of 40. The single most upvoted comment, over 3,000 votes, said this: "The thing that changes is how much you think about tax efficiency. Not, I wish I had started sooner. Not, it was too difficult." People who built real wealth starting in their 40s were not primarily discussing regret. They were discussing the next level of the strategy. That is where this conversation is pointing. The second advantage is clarity. At 25, most investors are still defining what they want their life to look like. At 40, you know. You know your risk tolerance because life has already tested it. You know your income trajectory because you have already built one. You know your real expenses because you have already lived with them. That clarity prevents the emotional decisions, the panic selling, the speculative chasing of returns that quietly destroy young portfolios long before compound interest ever gets the chance to work. The third advantage is urgency itself. And here is why that matters. The urgency you may be feeling right now, the recognition that the window is real and the math does not negotiate, that is a cognitive asset. Most 25-year-old investors do not feel it. They operate as though the horizon is unlimited. You cannot afford that luxury. And that constraint, properly directed, becomes one of the most powerful drivers of financial discipline there is. The urgency is not a disadvantage. It is a differentiator.
Chapter 7. The 90-Day Logic Sequence. If your money feels like a desk buried in overdue folders, do not try to fix your whole financial life in one heroic weekend. Use a 90-day sequence. 3 moves, 1 quarter, no magic. Month 1. Stop the leak. If you have high-interest consumer debt, especially credit cards, your first extra dollar goes there. Not because investing does not matter, but because 20% interest working against you is a wealth-building emergency. Pay minimums on everything, then attack the highest interest balance first. Every dollar you remove is one less dollar fighting your future. Month 2. Build the floor. Before putting new money into the market, create a starter emergency fund. Aim for 1 month of essential expenses first, then build toward 3 months. Keep it in a high-yield savings account, not as an investment, but as protection. Its job is simple. Stop a car repair, medical bill, or job scare from forcing you to sell investments at the worst possible time. Month 3. Make wealth automatic. Open or use a tax-advantaged retirement account. In the United States, a Roth IRA may be an option if you qualify. And for 2026, the IRA contribution limit is $7,500 if you are under 50, or $8,600 if you are 50 or older. Inside that account, keep it simple. Consider a low-cost total market index fund, and set a monthly automatic contribution you can sustain. Then add one rule. Every quarter, increase it by $100 if your budget allows. Not dramatic, not perfect, just consistent. Debt first, cash cushion second, automated investing third. That is the 90-day logic sequence. The goal is not to predict the future. It is to build a system sturdy enough to keep going when life gets expensive.
Let me bring this full circle. We opened with $374,000. That is what compound interest extracts from 15 years of delay applied to the same strategy. The goal of this video was never to produce guilt about that number. It was to make it visible, because the decision to act or not to act should be made with complete knowledge of what that decision actually costs. Here is what I want you to carry out of this. The window is real. It closes by approximately $10,000 per month for a person beginning at this stage of life, investing at a modest rate. That is not a motivational statement. That is the math. But the window is not closed. The 40-year-old investor who understands exactly what is at stake, who moves with the urgency the numbers demand, and who deploys the income, the clarity, and the focus that their decade of professional experience has built, that investor is not locked into the $113,000 projection. They can build the $1.18 million outcome. The difference between those two numbers is not talent, it is not luck, it is not timing the market or finding the right advisor, it is decision, and then consistency, and then time. Here is what I want you to do right now. Not after this video, right now. In the comments below, tell me this. What is the one thing that has been keeping you from starting? Is it debt? Is it not knowing where to begin? Is it that the market feels too uncertain right now? Is it something nobody in financial content has given you a clear, logic-based answer on? Whatever your answer is, that comment informs what gets built next on this channel. And if this video gave you one number that landed, one mechanism that clicked, one assumption that shifted, share it with someone who needs to hear it. Specifically, the person in your life who has been saying, "I will start soon" for the past several years. Tag them, forward this, send them the link.
Also, don't forget to check out the links in the description below. I've curated some powerful resources for you. Everything you need to level up in wealth is just one click away. Before we end the video, and to actually achieve the financial success we just talked about, click the video on your screen right now to master Atomic Habits. Watch it until the very end because it reveals the exact science of building good habits that stick. Don't forget to like, share, and subscribe. See you in the next one.